believe is that, a very simple call that one could have taken in April this year was to just lean on the US Fed after the pandemic and the health crisis, and say that everything is going to be fine in this world since the US Fed has been printing a lot of money. And if you clearly remember, from April to May, what was happening in the market was very, very interesting. That every week practically you'll see two announcements from US Fed. And that is why we believe that global experience is very, very important, including my colleague Praveen, who has joined on this call. Essentially what you'll find is that we are trying to marry local and global experience both as a part of our strategy. uh, from a perspective of return on capital and return of capital, we believe that that markets typically tend to move in cycles. And what we have found over last 20 years, since I have started to invest in the market in 1999, is that there are these periods like 2000, 2008, and in 2011, wherein markets typically tend to tank. And what happened in 2018 as well, especially on the mid and small cap side, was that we saw a very, very sharp correction of 50%. More often than not, as a fund manager, I've been asked this question by clients every now and then, that that we are first time investors into equity markets and we don't know that the asset class can be volatile. But the fact of the matter is that it is a reasonably volatile asset class. Everybody knows that over a long period of time you end up making handsome return in equity, but you have to tide through those periods wherein you can see to 20, 25, 30% drawdowns. These drawdowns are very, very common in indices. They are also very common in stocks. So what we have said is that return on capital and return of capital, both the things are very, very important, essentially from a perspective of looking at things. What we did actually was, we returned 700 crore worth of clients' money. We used to manage. I used to manage 4,000 crores at ICICI Prudential AMC, and what we did was, by returning 700 crores, we demonstrated that skill and luck both need to be matched at some particular point in time. And what we have said is that one needs to act as a fiduciary of clients' money, and one needs to take that view in terms of managing money for the clients, and one has to stick his neck out. One very important thing that I would highlight here is that as a part of orientation, what we have said is that return on capital, return of capital, both are, why they are very important, because once an investor has achieved its goal of investing into a product, it takes it makes reasonable sense to essentially take a stock of situation and sell into essentially what we call uh, greed, and buy into fear. That is what a very simple thing that you would read across many investment textbooks, that investing is very, very easy. You should buy fear and sell greed. In practical life, what I have seen is that it is very, very difficult to implement these decisions. It could be possibly a combination of things like, in the pandemic year, something like, uh, basically taking a call in terms of investing in April. Now if you look back, how many of us had the courage to deploy capital in April, because essentially we were going through a health crisis. Like any other asset class, you need to be overweight or underweight on equity depending on the horizon or your asset allocation. We are very, very aligned to clients in the sense that we have contributed most of our net worth into the fund, and goal setting is very important for investors. So once you have achieved your goals, obviously you need to reassess and measure them in a very objective fashion. So that becomes very, very important. As a part of our decision making process, the way we think about it is that there are three things essentially which are very, very important as a part of investment decision making. One is buying. So what we say is that we have to focus on buying into great businesses at fair value, and we have to buy good businesses at discount, and we want to avoid bad businesses. And later on I'll demonstrate how do we differentiate between great, good, and bad. Very important part of investment decision making process is how much do you buy when you buy, and this is what we call as sizings. How much do you allocate? These are the most critical and the most important decisions that we need to make as a part of the fund management process. And these decisions are very well demonstrated by great investors like Warren Buffett or Rakesh Junjunwala or Radhakrishan Damani, wherein most of the high quality investors who have created wealth out of equities would have allocated more to a particular stock or to a particular portfolio. So these decisions become very, very critical and very, very important when we invest into a company. The third very important thing is selling. So when do you sell? Obviously, it is a well-known fact that you sell when there is a deviation from the investment thesis. You also sell when your incremental upside to downside ratio is unfavorable. So in 2018, the way I was thinking as a manager was very simple. That I've already generated 37% CAGR, 3x in 4 years, 4.3 years. Investors have a very superior experience. One approach that I could have followed was that my stocks are just fine. Typically fund managers love their stocks. But another approach that I could have followed was that to look at incremental upside to downside in the portfolio. And what I saw was that the risk was much more than reward. So what do you do then? Possibly at that particular point in time, you take a decision to sell or to move out of equities, or to switch to some other product, or to a category from small cap to large cap, essentially. So this is what I meant. Essentially in our framework of things, 50% of our job is sizing and selling as a manager, and 50% of our job is buying. Now the key question here is that how do you differentiate between great, good, and bad? So for that we have created a framework. What that framework says, and it is divided into two parts, quantitative and qualitative parameters. What we have said is that as a part of the framework, we would like to be very, very objective in our decision making process. When we evaluate a company, we want to buy great business at fair value, because there are very few great businesses which are available at fair value. Good business at a discount keeps on happening because there are business cycles, and there are stock market cycles in a particular business. So what we see is that let's say a Maruti, let's say a Page Industries, let's say a Bajaj Finance, these are all examples of short and long duration business cycles. Who would have imagined that a Page Industries would have a negative same store, negative volume growth? But in a country like India, wherein innerwear is very, very under penetrated, you saw a time wherein volume growth was negative. Autos, obviously, every 5 years we see a scenario wherein either the tractor sales growth or the passenger car growth is very, very minuscule, or it is low single digit. That is the best time to look at companies, and this is what we clearly believe in, to focus on businesses or to buy businesses when you get good business at a discount. And it's a recurring thing. It keeps on happening even in best of the NBFCs, which is something like a Bajaj Finance, wherein people believed that from 2008 to 2020 there was no cycle. Pandemic proved that there is a cycle in that business. So what we say as a part of our thought process is that you need to be very, very focused, or be slightly price sensitive to the price that you are getting into in a stock. So as a part of our framework, what we have said is that great, good, and bad we have to avoid. The first parameter that we look in a company would be return on invested capital versus weighted average cost of capital when we evaluate a business. Typically what we have found is that in most of the great businesses, you'll have not even a single year wherein you don't beat cost of capital in a business. So that becomes very, very important in a good business. For most of the majority of the business cycle, the business will beat cost of capital. uh, in a bad business, it will never beat cost of capital. The second thing that we'll typically look at in the company that we invest into would be a capital structure efficiency. How do we define that? Typically, if you think about a great business, it is having negative working capital or debt to equity, which is less than 0.5 times. In a good business, debt to equity could be 0.5 to 1. In a bad business, it could be inefficient. The third thing that we look in a company would be cash flow. In cash flow, what we typically look at is operating cash flow yield in a business, and we look at EBITDA to operating cash flow conversion. Cash flows are the most important part of the financial statement. What investing has taught us is that a P&L is vanity, balance sheet is reality, and cash flow is sanity. Essentially, that is very very important to highlight it here. So what we typically do is that we'll first look at a cash flow, then look at P&L, and then look at balance sheet. The fourth important thing is to look at covenants in a company. By that we essentially mean debt service coverage ratio. If a company is taking loan from a bank, whether they are appropriate, average, or poor. Growth is very very important when we invest into companies. We don't want to invest into companies wherein growth or catalyst are not known. Now it is a different matter that a business could be in a down cycle and it could be just recovering. What we typically do is that we typically would evaluate companies on a profit pool, by understanding the profit pool of the industry and the sector and the company within that sector. So just to give you an example here, let's say in any industry, what you'll find is that top three players are 50% of the revenue pool, but they would be disproportionate profit pool, something like 70%. So as a result, we typically tend to invest into leaders when we invest into companies. And what you'll find is that 60% of our portfolio comprises of leaders, 25% of our portfolio comprises of challengers. Rest of the companies would be in sectors wherein they could be either number three or number four. But our endeavor is to invest into leaders. On the qualitative side, we would typically look at identifiable and sustainable competitive advantage. That is a hallmark of a great business. Now, this has been traditionally brands. This is getting disrupted very, very heavily as I speak. Identifiable but fading in a good business. Now, the fade rate, it can take 5 years for uh, for a business model to reinvent itself and fade. Think about branch banking here. Whether branches are important for a bank. In a digital world, possibly branches are not going to be as important as it used to be for a bank in the past. Pricing is very important, whether the business has got pricing power, which beats inflation, market pricing, or price taker. Character of management, you can only judge if you have tracked the same company and if you have got considerable experience. We'll typically look at four or five things in character. We would look at pledge shares, we would look at contingent liability as a percentage of net worth, we would look at management remuneration, we would look at how the management behave, how they guided in the previous cycle. All these things are very important. And then we would look at alignment of interest with minority shareholders, because we'll always be minority shareholders because we invest into listed equities as a universe. The last thing that we look at is dependence on external variables. By that we essentially mean how's the regulator in the sector. Now the key question came that this is a wonderful framework, and how do you put this to practice? So what we actually did is that we created a score. And what we said is that we need to be objective in our assessment when we look at companies. And what you will find is that the way we score companies is very very simple. For a great business, we'll have a score of 3. For a good business, we'll have a score of 2, and for a bad business, we'll have a score of -2. As a result, it is very very easy to differentiate between bad and good. From good to great, we don't even realize that something is good and it has become great. So that becomes very very important to highlight it here. Essentially, we are looking to invest into great and good businesses as we move forward. So what you'll find typically is that we have invested into market leaders and challengers, but on a score based system. The maximum score that a company can get, because there are 3 points for a great business, a great attribute. The maximum score could be 30. For a company which has to be a reasonably successful investment, all the market leaders that you can think of, HDFC Bank, Asian Paints, the score is going to be in the range of 24 to 26. But the trick here is to buy all these companies at a right point in the cycle. That is what something I would highlight. Another thing that we are mindful about is that we typically don't invest into companies wherein the minimum score is less than 20. So that is a minimum qualifying score. And we can obviously, depending on what events happen, we can revisit the score every now and then. So this is what I wanted to highlight on the scoring model. What you'll find here is that the strategy navigates between large, mid, and small. Roughly 40% of our portfolio comprises of large cap companies. which are greater than $3 billion. Mid between $1 to $3 billion is close to 23%. 40% of our portfolio comprises of companies which are small caps, which is less than $1 billion in terms of valuation. What you'll find here is a good mix of companies, and what you'll find here is that what the list that is getting displayed here is the top 10 holdings in the portfolio. Linde India, United Spirits, HDFC Limited, all these companies are market leaders, and Matrimony is also a market leader. You've got Thyrocare and Bharti, which are challengers essentially. So when we buy into a small sector, we'll make sure that possibly we are looking to buy into a market leader. Another very key element of our strategy is to focus on earnings growth and balancing earnings growth with right quality metrics, which we define as return on invested capital, and at a valuation which is not exorbitantly priced. So we will typically be a slight premium to the market, because essentially we are doing quality investing at reasonable price. But we won't be typically, be, let's say, more than 50% of the market multiple. So let's say market multiple is 30 on a trailing basis, FY20. Our PE is much more reasonable, and the average market capitalization is 6.5, $6.6 billion. Uh, Now I'll just, for the benefit of everybody, I'll just move to the market view, which is very, very important to highlight here. So, why this cycle? And, I keep on getting this question every now and then, that where are we in the cycle since, I've returned capital in 2018. I believe that there are a couple of things and couple of beliefs that I have as a fund manager. The first belief that I have is that if India has to do well, or if any economy has to do well, essentially auto and real estate have to do well. Why auto and real estate have to do well? Because auto is a very, very large part of industrial output in any country. So if you look at, a full throttle recovery in any economy, auto becomes a very, very important part, basically. And as we are all aware that, if we have to dissect two-wheeler market, tractor market, four-wheeler market, or possibly CV, which is the latest one, and it is the last in the cycle to recover, we are seeing recovery across. The second point is that, our belief is that real estate has to do well. After agriculture, real estate is the second largest employer in this country. And what we see at this particular point in time is that there are three very positive things which have happened post the pandemic in the real estate market. The first thing that happened was that, there was change in attitude of builders in this country, wherein builders were willing to sell at a price which is, let's say something like 30 to 50% price wise correction, or there has been a very long time wise correction in the market. That is something which is very, very visible. The second thing which has happened is a change in attitude of government, wherein what has happened is that, there is the first time after many years I'm seeing that, including the stamp duty cut in Karnataka yesterday on the low cost housing side, that, the government is willing to sort of, cut or do away with government revenues. That speaks a lot about the way government is approaching this sector at this particular point in time. And the third most positive thing which has happened in this sector is, we are in a world wherein a home loan on mortgage rate in this country is 6.75%. Now it was practically impossible to believe that, housing rates could be as low as 6.75%, which is being widely advertised by big banks like Kotak or Citi at this particular point in time. And I would highlight one thing here, that what has changed in the markets of late is that it is a combination of uh, lower rates for longer, and that is what has happened basically at this particular point in time. What we see in the markets is absolutely baffling, because a AAA rated corporate like NTPC or a Reliance or a HDFC is borrowing at 3% on the commercial paper market. Even Bajaj Finance on a 3-year paper is borrowing at 4.5% at this particular point in time. So rates have absolutely crashed. There are not many people who believe that, rates can continue to be longer. But if you logically think about it, what Modi has created in India is a combination of a lower cost of capital, which has got to do with essentially a deflationary environment globally. I cannot give all the credit to the PM, but I would say that we are living in a world wherein cost of capital is declining. Labor and land prices, obviously, they have been, declining with rising unemployment in this country, and land prices have been, moderate. So essentially, land prices used to be 60% of a project cost of a project. Today it is more like 40%, which is much more reasonable. So what we have seen is that, land, labor, capital, all these factors of production has created deflation in this country. And the fourth very important factor is going to be technology. And what we see at this particular point in time is that Reliance, and I'll give a lot of credit to Reliance here. Basically, essentially, what is happening is that, Reliance is creating technology deflation in this country. So what we find is that, the return on capital cycle, as and when it starts, is going to be a very, very healthy cycle. Another trend that we see in the market is that, the problem earlier for banks was that, it is irrespective of the RBI cutting rates were not getting transmitted. We are living in a world wherein the cost of fund for a bank today is more like three is 4.7%. The reverse repo, the that is a that is the rate at which you can park your funds as a bank to RBI is more like 3.3%. So there is a negative carry that leads us to believe that at some point in time banks will start to lend. That is very, very important. What we are seeing is today is that, the spread between a triple A, a double A, and a A is not coming down. What we believe is that, the next phase, possibly the spread is going to come down. So that is something that I wanted to highlight as a part of this conversation. It feels like, if I have to break this story in terms of where we started post the pandemic, what we also saw is that, the first thing that started to move was pharma. Now there was no challenge in pharma. It was a beaten down sector. Then it got spilled over to IT. Initially people thought that IT is going to, sort of suffer, but what we clearly saw was that, IT benefited out of the pandemic. These are the two sectors wherein, the strategy focuses on. The second thing here is that, India is globally competitive in both these two sectors. Another thing which happened in the market was that, auto started to do well because of the narrative change in favor of, personal mobility post the ride share world that we were living in, and that is a part of the gig economy. uh, what happened subsequently was that financials did well, and this is a precise reason, because initially people thought that there are going to be a lot of NPAs, but it was the opposite position that we saw. That, post the pandemic banks are overcapitalized, in the sense that, you've got banks like Kotak or or Axis Bank, which wherein the capital adequacy that they are running is close to 19% and 23% at this particular point in time, and that is what leads us to believe that there is going to be a start of the cycle. And then subsequently our belief is that consumers should do well as a sector, as a logical consequence, because as it was initially feared that there are going to be multiple job losses and the salary cuts are not going to get reinstated, we have seen a reversal of most of them. So our belief is that, the economy is going to do well in a low interest rate environment. What it means for an investor is very, very simple. That, essentially, you would have expected 15% return from equity as an asset class. Now those returns are going to be more like, 10 to 12% in that range, if I have to put a number to it. A strategy which is very, very decent, and this is what we have demonstrated in our own product, uh, is going to create decent alpha. So I'm talking about, possibly net of fees and expenses, something like a 500 to 700 basis point alpha. That is the goal that we strive towards. And what you see is that, we have been fairly consistent right from the day we launched the fund, and we have recovered well. So that has got to do with, stock picking allocation, the way we have structured it. It has been a very, very difficult time as a fund manager to manage money in episodes like pandemic. But what we have clearly done is that, we have focused on improving the greatness score of the portfolio. So what you'll also find is that, you have got companies like MRF or Marico or something like a Bajaj Finserv, wherein we believe that these are clearly one of the possibly the best managed companies in the sector. So what we have done is that, we are trying to strike a balance between value, growth, and quality, as I clearly highlighted. And in this environment, I think so we will continue to be in a world wherein this is going to be a buy on decline market. We don't believe that, there could be corrections which are going to be very very sharp. All the decline has to be bought into, in our view. What has also happened is that, and one should remember this, that the last decade belonged to America in terms of developed market returns. US markets have done too well. The last decade was a washout for emerging markets. So if you look at Brazil, Russia, China, and India, those are the BRICS. It has been a washout decade for most of the emerging market economies. And our belief going forward is that, it is going to be a very very supportive environment for emerging markets, and there is going to be mean reversion in emerging market valuations, so on and so forth. So our belief is that, it is going to be a very very constructive environment, because we are coming out of a very very bad cycle in a market like India, when capital was misallocated. A lot of promoters who took inordinate risk are out of business today. Banks are very careful with lending, and what we find is that, this is a very very good construct for the start of the cycle. Another thing that I would like to highlight here is that, globally there is money which is shifting from bonds to equity. Within equity, there is money flow from developed market to emerging market, because essentially in US what has happened is that, we have seen 13 years of record earnings. uh, and what we are seeing at this juncture is that, there are peak multiples in US market is not cheap. Indian market is not cheap on a multiple basis. But what we have also seen is that, earnings growth has been very very tepid in India. So last 8 years, from FY12 till FY20, earnings growth has been in the 2% sort of a range. So our belief is that, there could be 3 years where an earnings growth can surprise. So this is what I would like to highlight. I am most happy to take uh, questions that on the strategy, on the markets, or anything that you want me to elaborate on.
Thank you. Thank you so much, Aditya. So, participants, if you have any questions, you can use the Q&A box at the bottom to ask your questions. And in fact, we already have our first question, Praveen, if you want to take that.
Yeah. In the meanwhile, when everyone is trying to type their questions, the first question which has come is, given that we are 40% into a small cap allocation, how do you see the liquidity in the portfolio, and how would you like to manage liquidity in small cap stocks?
So liquidity is paramount. When we invest into a company, there are two ways to wherein we try to manage liquidity. One way is that, we typically don't invest into less than 1,000 crore market cap, because if I have to invest into a leader in a particular sector, the size of the pie is too small if the market cap is less than 1,000 crore. So what you'll find here is that, the lowest market cap in the portfolio today would be something like a Matrimony, which we when we bought was 1,000 crore, but today it would be more like, 1,700 1,600 crore thereabouts. So that is one way to manage liquidity. Second thing is that, we would typically, we have an internal rule wherein, we should be in a position to either build or exit a company based on one third volume on a 5-day average basis. So liquidity is paramount. Another thing that we believe as a strategy is that, one needs to be counter cyclical. If you have to compare similar multi cap strategies, which are available on, let's say, something like a mutual fund platform, what you'll find is that, we have been more overweight on small and mid caps from day one, because we believe that having returned capital at the peak of small cap boom in 2018, when I was launching a fund in 2019, 2019 January, after roughly 18 months, clearly I believe that there is a lot of value in the market, and that value needs to be capitalized on, and that gets reflected in alpha that we have generated for the investors. And I think so we have done a decent job. So liquidity is paramount, but how do you manage liquidity is by having or following this framework of investing into the best company in a small sector. So if you look at, let's say a Linde India, it is $100 billion MNC globally. Linde India is not even, $1 billion. So it is just getting into a $1 billion club now. So our belief is that, you can look for quality companies, and more importantly, you look for companies wherein small can become mid cap, mid cap can become large cap, and large cap can become giant cap. That is how we think.
Praveen, you want to take the next question?
Yeah, Aditya, the second question from is that given your track record of returning capital at the peak of the market, what is the time duration you estimate for investing in today's time? And maybe what will be your strategy about this particular fund on return of capital in the time horizon we are looking at?
So, a very simple way to think about it is that, that business cycles typically used to be something like 8 years earlier. We have seen a 1993, uh, 2000, 2008. Now the business cycles are getting shorter. So this is a product wherein the endeavor is that, we will have, economic recovery for one cycle. So essentially, when we launch the product, what we said is that we are launching in an election year. We don't want to take election risk, so we've launched from a perspective of having 4 plus 2 years, because we don't want to. I've been into markets wherein you get a upper circuit and a lower circuit in an election year in the market basically. So as a result, whatever gains you make, you tend to lose those gains. So we are very mindful about that. As long as we can find companies wherein the risk to reward is like 1:3 in actual world. And why do we need 1:3 risk to reward? Because there are some things that I cannot forecast as a fund manager. Some things like a pandemic, or something like a capital gain tax getting introduced in the budget. So we are very mindful about it. That is why we believe that 1:1 is a very unfavorable risk to reward to invest into equity. That by that we essentially mean 50% upside to a 50% downside. So the way we constantly evaluate our companies is on a 1 year fair value or a 3 year fair value. And when a 3 year fair value gets achieved, possibly we'll tend to sell the company. In this strategy, obviously the endeavor, being the first product from the house, the endeavor is to return capital and obviously create a superior experience to clients. This is very similar to a private equity model, and a closed-ended AIF gives you that advantage in terms of returning capital to clients. So it is very simple from a manufacturer perspective. You basically take a check from the client and bank that check, in the sense that you give that money back to the client, and that is how we are aligned to profit sharing, fees, so on and so forth. So that is something that I would like to highlight. Just also highlighting that as a part of our own allocation, we are heavily invested into the fund. So that means that we have got decent skin in the game. For most of the clients, we are the third or the fourth manager that typically clients will allocate to. But for us, this is the fund that we have heavily invested into.
Thanks, Aditya. The next question is that your optimism about economic growth in India, combined with the recovery we are witnessing recently, is possibly going to continue. But you did mention that the returns will not be in 18-20% range, but rather 10-12% range. Why do you think that?
See, simply because we are in a low interest rate environment, basically, and stock markets, market returns, and nominal GDP growth can delink itself, or earnings growth for that matter. So we are at a start of a cycle, but for the cycle to be full throttle, one needs to see how the cycle progresses, and that is very very important to highlight. We are living in a fragile world globally. The thing that bothers me is about US valuations or US market today, having US being a star market for so many years now. So our view is that we need to be more balanced in our approach. What we have demonstrated in our own strategy is that we were in a position to deliver returns which were much higher than what we had also anticipated. So what I meant to say was that if equity markets give a return of, let's say, 10 to 12%, and if the strategy gives a return of something like 15 to 17%, it is not a bad outcome for investors. Now, depending on the strategy and depending on the positioning, returns could be higher or returns could be lower.
Yeah, thanks, Aditya. Looking at the markets where they are today, do you think it's a good time to allocate? And what will be your deployment strategy in the AIF if one
at one go, or you will do it in a phased manner?
So this is how the product is positioned. We can the way the structure of the product is that we are calling for 50% of the money today if markets correct, and surely you'll have correction in selective pockets. The idea is to position ourselves so between today and March, roughly we do the deployment. What we also find very interesting at this juncture is that that capital call would be dependent on how markets do. So if we see a very very sharp fall, obviously we'll call the capital. Obviously it has a bearing on the outcome at any given point in time. So what we are trying to balance for investors is that we are trying to do a right combination in terms of calling 50% of the money today, and hopefully if markets correct, obviously what we are seeing in US, including the listing of Airbnb yesterday, was what we have seen DoorDash and Airbnb getting listed in uh, last week. Clearly, listings have been very very euphoric. What we have also seen, particularly in the Indian market, is that I am not a typical fan of IPOs, but what we have seen is that there is a herd which is chasing IPOs which are happening at this particular point in time. So I think so. It is about being balanced, take things in its own stride. But I think so. We have kept a decent leeway in terms of deployment. On top of that, we can always choose to have 10-15% cash in the portfolio. And as you can also understand from the portfolio construct, that three of the sectors that we focus on are low beta. In the sense that healthcare, consumer, uh, and essentially IT have been defensive sectors. So what I can say is that this is a aggressive conservative fund, basically, depending on the cycle that we are in.
Yeah. Hi, thanks. Another question is that your picks in the portfolio are quite different from the street. What's hot on the street, like the Kotaks or the HDFCs or the paint companies or the B2s. First of all, what's your take on those stocks? And secondly, the divergence you will get on this portfolio will be positive for you. So more likely, why you choose this against the most commonly allocated stocks?
So actually, that is a question that I would love to highlight. That essentially, we don't own Kotak or HDFC Bank in the portfolio, and what you'll find is that by being growth contrarians, what we have found is that when we were investing, there was a leadership transition in HDFC Bank. Now what has happened is that what we saw simultaneously was that NBFC became a bad word to invest in the market. But what we said is that in the troubled sector, we are going to buy the leader, and we are clearly buying the top-notch company in the sector, which is HDFC Limited or something like a Sundaram Finance. Now there are no question marks on these two NBFCs, in the sense that most of the people know that Sundaram Chola and HDFC are the best NBFCs. Now the sector is going through too much of trouble at this particular point in time, but we are buying for the next cycle. So to generate that alpha, or to generate that extra little bit return over a period of time, what we believe is that our approach needs to be differentiated. But we are trying to be very very balanced here, in the sense that I have not seen a time in my career wherein HDFC Limited was trading at one time price to book, and at 1550 or at 1650 or 1600, from day one we have it in the fund. It was trading at one time price to book. It was so cheap, basically, and nobody believed that HDFC stock price can do so well. And the stock has given 30% return of late. What we have also seen is that there is no challenger to HDFC in the NBFC mortgage lending space. Earlier there was a theory that the next HDFC is Piramal or it is India Bulls, but today there is no challenger to HDFC Limited construct. So we found this to be a very very interesting construct. Similarly, what you'll find is that hardly you'll find people owning United Spirits or people owning something like a ITC in the portfolio, and we own both the companies. They have underperformed, or they have not made money for last 5 years. We have got every reason to believe that there is a catalyst. The similar logic we applied in MRF. Last year we bought into Ashok Leyland when it was out of flavor. We made decent money. We bought into Maruti. Clearly these companies are market leaders. We bought into MRF 3 months back. So our view is that, you can buy the best company if you respect the cycle, and if you are very, very confident about the cycle, you can position yourself. What I don't believe is that, either you have to be in a earnings lower camp, or you believe that earnings are going to recover, and you believe that the environment is very, very constructive. We are in that camp. So what I believe is that, earnings growth is going to surprise to most of people. The consensus is talking about, something like a 25% earnings growth. We think that, we are moving in a very, very interesting environment, because earnings growth will surprise people. So we are clearly positioned for recovery. For example, we own Thyrocare, we don't own Dr. Lal Pathlab. Clearly you can go and see that, Thyrocare has outperformed Dr. Lal Pathlab over last, 14 months. So what we believe in is making money for investors, and what we believe is that, most of our companies are very well managed at a portfolio level. We are net cash at a portfolio level. We are not taking inordinate risk for the clients, but it is a combination of, buying the right kind of strategy, or buying into, good companies at a discount to fair value when the cycle is not in favor, and buying into, great companies at fair value. So what you'll find is that, we have a greatness score internally that we measure our companies on. 60% of our companies are great companies, and that is how I would like you to think about this portfolio construction process. Now, growth at any price, that is what I call it. All the multiples of, lot many companies which have shot from 40 to 60 to 80 to 100. Unfortunately, history teaches us that, Microsoft doesn't make money for 10 years. It has happened in the past. What we have also seen is that, a great company like Coca-Cola doesn't make money for investors for 20 years. Reliance didn't make money for investors for 10 years. We are living in a world wherein, people have a ITC hater club, and it is the most mocked, sort of stock on social media. What we have found is that, that the competitive positioning is getting better. So as long as we monitor our companies carefully, we can identify the catalyst. We are very, very happy to do growth at a reasonable price, as opposed to doing growth at any price.
Thank you, Aditya. That was great. Mr. Venkatram, do you want to ask a question? You had raised your hand. You can ask your question if you want to. I have unmuted you.
Why do you call pharma as a defensive stocks?
See, pharma is one of the sectors wherein India is globally competitive. If you look at, how pharma has behaved, pharma has its own cycle. But if you look at, the components of pharma growth, it is ultimately a sector wherein volume growth, looking at the dominant positioning of, Indian pharma companies globally in terms of, value and volume market share both. We are very minuscule in terms of, value market share. It is known to people. We are 40% in terms of, US market share in terms of volumes, in terms of generic. What we clearly believe is that, this is a defensive sector, because India is globally competitive in this sector, and we are living in a globalized world. We are not living in a silo world. Similarly, IT, now it is a different issue that, from time to time you can have these periods of wherein, pharma gets re-rated and it generates a lot of returns, and pharma could be out of flavor. That is a function of cycle. So what we believe is that, because of the competitive advantage that we have as a country, pharma, IT, and possibly, consumer. Now, one approach that we have followed on the consumer side, and just linking pharma and consumer here, is that, valuations could be a different issue. So the route that we took in consumer is that, we don't want to buy expensive companies in a sector which is 2x more expensive than the market. So what we said is that, we would lean towards companies, wherein we'll respect valuations. So our view is that, if you look at pharma components of, let's say, hospitals as a play, or diagnostics, so this is how we look at the sector, healthcare in totality. What we have found is that, it is generally defensive, and, obviously diagnostic businesses have been capital light, or hospitals have been, they have got minuscule market share, even though leaders have got market share of less than 3-4% in this country. So our belief is that, that is a sector because of global competitive advantage, which will do well over a period of time.
Will it be sustained?
So key question depends upon how do you, I can tell you what is happening at this particular point in time. There is a very large shift in supply chain, and there, after the pandemic, first time there is a realization that we are willing to buy or source APIs, let's say from an Indian company at 10% higher price, but we want to diversify the base, and that is what we are hearing from more and more companies. So it is a combination of both. Whether it will be sustained depends upon India's competitive positioning. But let me tell you this, that possibly we are reasonably competitive. We are not. I mean to say that the cost curve differential between a China and India is 10%, and we are living in a world of tariff barriers. We are living in a world wherein political agendas are more important. So what we find is that it will essentially depend upon competitiveness of companies, but we are reasonably competitive from a global landscape.
Thank you very much.
Thank you, sir.
There's one question in the queue, and before I ask that, if participants, anyone wants any other question, you can type on the Q&A box or even raise your hand. Aditya, one question in the queue is that we all know, and many of us obviously know, that we would come out with a PMS portfolio sometime in coming weeks in Jan or Feb. Would your PMS portfolio be very similar to what you're managing currently at AIF? Or how do you think between the two strategies?
Sorry, I just lost you. Can you just...
Can you hear me now, Aditya?
I think, Aditya, maybe you can switch off your video. It might be a low bandwidth issue. Or I think, Praveen, do you want to answer that question yourself if you're here?
Sure, I think Aditya got disconnected. So obviously, to answer that specifically, is that we are looking to launch a PMS in sometime in Jan or a few weeks from now.
Sorry, Praveen, if you can be a little louder.
Yeah, sure.
Yeah, a little louder.
So, as you all know, we are looking to launch the PMS in coming weeks' time. However, given that this AIF is a closed-ended platform, and we could go as high as 30-40% into small caps, the open-ended platform would have its own challenges. The broad framework and at this point in time looks that the name of the stocks would remain broadly the same. I would say a 60-65% overlap. But depending at the time and the liquidity of stocks, the open-ended PMS may be, to the extent of 30-35% different from the AIF. Radhika, I see no other questions in the queue.
Yeah, I think, there are no further questions. We're so sorry. I think Aditya lost his connection. Maybe he's just coming back. All right. We can't still hear you, Aditya. Hello?
Aditya, we can't hear you. I think the audio has an issue. No, I think Radhika is facing some technical issues in terms of.
I think there was one more question. We would definitely get back to you with an answer to that, but since you've lost Aditya now, and it's already we've overshot our time. So thank you so much, all of you, for joining us today here. I think Kalpesh Dave, who's our managing partner for the West region, will be in touch with all of you along with his team and answer all your questions and note down your interest in the specific fund of InCred AMC. Thank you so much for your time. Thank you, Aditya. Thank you, Praveen.
Thank you, everyone. Mr. Sanjay will get back to you with the answer separately, and any one of you can connect with your relationship managers if you have any more questions. Thank you.
Thank you. Bye.